Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. The ever-present mid-April to late May bearish Andrews pitchfork, specifically the declining middle tine below the market, currently at 19,235, and the upper tine above the market, currently 21,915, continue to drive this market lower, and nothing is challenging it for dominance at this time. However, something may be on the horizon. This is in the form of the lows from 2019 and 2021, specifically the August 2019 high at 18,850, the June 21 high at 18,610, and a nondescript high from May 2021 at 18,265. That last one halted the decline last Friday and started the current move back up. Now, the overhead resistance, well, that is the May 2014 high at 21,610 and the significant February 2014 high at 22,155. But you should also add this, the upper tine, currently at 21,915, because if the upper tine is broken, and I don't just mean pierced, I mean properly broken, then we'll have a new situation on our hands. Why am I being so forceful on just one part of a pattern? Well, it is because the short moving average, currently 21,770, is wrapped around the upper tine, and there seems to be nothing beyond it until the flatlining long moving average, currently 24,445. LME 3-month zinc. There continues to be a lot of interesting things going on here right now. First off, the context. I've previously often spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these I noticed a significant pattern here, still in operation, plus a second pattern that was formed and is also now in operation. The principal pattern was the 2015 to 2020 bullish Andrews pitchfork. The most recent events involving this pitchfork were on the end of May and start of June, when the market approached the middle tine from below, currently 40.01, and was rejected, and then again most recently the market moving down to within sight of the lower tine, currently 26.72, just emerging from the bottom of the daily chart. Okay, so if we go back now and look a little more closely at certain elements in this market, in mid-May, and then especially in mid to late June, we can see for the former how the market came down and kissed the lower trend line, currently 35.88, of the second large pattern that I noted a while back and was then being formed on the longer term charts. This lower trend line was from a very large ascending expanding wedge pattern. In mid to late June, the market kissed the trend line again and broke it. We are still seeing the implications of that break today. Hence, the primary target was achieved, but the secondary, much harder to achieve target X1 is still live and out there, though it's a way lower, below the bottom of my daily chart right now in the 2082 area. Looking at the prospects for target X1 being achieved, I would say it would be fair to treat this at the very least as a longer term target. Now, there are a few more patterns that I'd like to discuss. The first is the prospective March to April bearish shift pitchfork. Now, I say prospective as the pitchfork, though it's been sitting there for a long while, I say this as prospective because the pitchfork has still not touched either the upper or lower tines yet. And until it does, it will remain, in my mind, prospective. The one tine that has seen a lot of action there, especially since May, has been the middle tine, currently at 32.10. In addition, we have a more recent bearish shift pitchfork for the mid-April to late May action. The market is at this moment either side of the middle tine of that, currently at 29.57. This brings me to the last pattern I'd like to discuss. The mid-April to date bearish halfway hesitation. This pattern had a target X in the 29.15 area, which was not that far away in relative terms when I last spoke. Well, last week the market dipped down on Thursday and achieved it. Prices carried on to halt at just short of the June 2021 low at 28.10, before on Friday making a combined key reversal up and bullish engulfing pattern. Now, we've seen a follow-through higher yesterday, but it seems that perhaps, just perhaps, much as in the last 2 weeks, the market does not like being above the middle time, currently 29.57, of this prospective March-April bearish shift pitchfork. Now, a word of caution. Below, we now have for this week, and maybe also for next week, an aggregation of supports. Notably, the lower time of the big old 2015-2020 bullish Andrews pitchfork, currently 26.72, plus both lower tines, currently at 26.67 and 25.74. I suspect that all these were the reason why the market turned with such a pattern, such a strong pattern last Friday, turned back up. The only thing to remember is that they are separating and dissipating also in force, and thus will be weaker. So an orderly continuation low would not be unreasonable and a test of those levels. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.